Hey, good morning, everybody. This is Greg with Ideal Trading Ideas, and today we're going to be bringing you my trade idea number 19. We're going to be showing you how to do a Hanesbrands Covered Call Option trade, right? So, as you can see right now, we have Hanesbrands up on the screen in our Robinhood portfolio, right? It's $18.36 a share as of right now. It went up 28 cents for the day, or positive 1.55%, and it didn't do anything after hours. So today is Friday, July 30th, 2021. And what we're going to do is run through the chart really quick. 1 day chart we've already saw, so we're going to go to the weekly chart, which says that we are up 33 cents or positive 1.83%. 1 month chart says that we're down 4 cents or negative 0.22%. 3 month chart says that we're down $2.91 or negative 13.68%. 1 year chart says that we're up $3.31 or positive 21.99%. And the 5 year chart says that we're down $8.50 or negative 31.65%. Right? So for anybody that is thinking about buying Hanesbrands right now, we see that the price is $18.36, right? So I always tell you guys, remember, I'm not a financial advisor, but I typically like to buy 100 shares of anything I'm trying to do. So when you're trying to do a cover call option trade, you have to own the shares, right? So we're going to pull the calculator out really quick and we're going to just do the math, right? So 1836 times 100 shares equals $1,836. So you're going to be paying $1,836 to own 100 shares of Hanesbrands Inc, right? So now that you spent that $18.36, and pretty much, hopefully you guys know how to do that, but we'll just show that to you really quick. You will basically put in the amount of shares that you want. Right here, you actually can just, I would say, go with the limit buy and type in where you want to, at what price you want to buy it at, and just put in the shares, 100 right there. And as you can see, estimate cost is $18.36. You would click on review order. Order will go through once the market opens. Right now, like I said, 6:47 a.m. So the market is not open right now. But review order, and hey, when the market opens up, if it's at $18.36 or whenever it hits $18.36, you'll be filled for those 100 shares, right? So $1,836 is what you would spend, right? So we're gonna go ahead and clear that out really quick. And what we're going to do is move down and click on trade HBI options, because hey, at this point we've already purchased our Hanesbrands shares, right? So first thing we want to do is take a look at the option chain, right? This whole thing right here is called an option chain for Robinhood. We want to change buy to sell, and we want to make sure that we have call highlighted, right? And then over here on the side, we have expiring today, July 30th. So the first thing we want to do is change that July 30th to July 6th, or whatever date you will want to use. In this case, we're going to use July 6th, right? So remember, you bought the shares for $18.36, and the next thing you see is going to be strike price, break even, chance to profit, change, and price, right? So percentage change, and then price, right? So strike price is the area or the price that you're saying you would like to sell the shares at. So if you bought at $8.36 and you're saying you're willing to sell at $18.50, it will tell you that, hey, if the price goes from $18.36 to $18.50, you would sell the shares at that price. Now, the break even is the price of the strike price and the price of premium that they're paying you up front put together. So $18.50 plus 70 cents is going to be $19.20. The chance of profit is 68.45%. So it's a 68% chance that the price is going to go up to $18.50 by August 6th. And then we have a percentage change, which is 20.69%. And a change in price, which is 12 cents, right? So it's went up 12 cents. So this is in relation to the premium that they're paying, right? So the difference in changes. So right now, we're just gonna say we're willing to pick the $18.50 strike price. So first thing you have to remember is the difference between the $18.36 and the $18.50, right? Because we have 100 shares. So the difference in that, and we just have to do the math real quick, and we'll just put minus 1850. Messed that up. 1850 equals $14, right? So the difference between 1836 and 1850 is going to be 14 cents times 100 shares, which is going to be $14. So you're going to make $14 for selling at 850. But what you want to remember is that they paid you 70 cents up front, or 70 cents times 100 shares, right? So it's going to be, we'll clear that out. It's going to be 0.70 times 100 shares equals $70. So we're going to get rid of that calculator real quick. So not only have you gotten $70 up front right here, you picked up 14 on top to make that $84. So how do we go ahead and do this covered call option, right? We just click on the plus sign. You see it says short call $18.50, negative 70 cent times. It expires on August 6th. Total credit is going to be 70 cents. And we can scroll down here and just see exactly what's going on. Expected profit and loss is going to be $70. It's going to be that 70 cent right there times 100. And then it says HBI price now, which is the 1836 that you spent up front to buy the 100 shares, right? So 1836 times 100 is $1,836. Max profit is $70. Max loss is unlimited, and break even is $19.20. Remember, the $19.20 is your strike price and your premium put together to make $19.20. So anything over the $19.20 mark, they're going to count as a loss. But is it an actual loss for you? The answer to that question is no, right? So if you look at the little dot right here, which is your break even, it starts showing that you start incurring losses, right? But really you don't incur any losses. This is just money that you are foregoing having because you decided to sell at $18.50, right? So once you sell at $18.50, you no longer have these shares. But if the price goes up to $19, then just take $19 even though you have to break even $19.20. So actually it would be $19.21 or above. As you can see, those are the monies that you would be foregoing, right? And it continue to go. Let's say Hanesbrands went to $50. You would have missed out on all that extra cash because you decided to sell at $18.50, right? So in actuality, you're not losing any money. So that's the plus side of having a covered call or doing a covered call option trade, right? Now, what if August 6th comes and it doesn't sell off at $18.50? What if it had dropped down to $18 right around here? Well, if it drops down to $18, it will be nothing really to worry about. You already collected the $70 up front. And what you would do is just repeat the same option trade the next week, right? Or if you want to go down a few weeks, you could. But let's go down to August 13th really quick. And let's say it had dropped down to $18. And then you can still go right here to $18.50. August 13th, they're offering $70. This would probably change. Let's say it dropped down to $60, but you would just repeat the same thing. And you would say, hey, I'm willing to sell at $18.50. And they'll offer you, let's say, $60 at that point. You would collect that $60 and you'll be looking for it to go to $18.50. Remember, even at that point, you still have the regular, your average cost of $18.36, right? So you would need it to go from 18 to 18.36 just to break even on the price that you pay for the shares. And then once it goes from 18.36 to 18.50, you'll once again possibly collect that money if it sells off by August 13 at 18.50 or higher. But remember, they gave you the premium up front. So now you have collected two premiums. The first premium was $70. And let's just, instead of going with 60, we'll go with another 70. They have right here, which means that you would have pocketed $140 in a 2 weeks time frame, and you would still own your shares if it doesn't sell off at $18.50 within that 2 weeks time frame. So this is how you guys would do an option cover call, right? So we're gonna actually go back to August 6th really quick and kind of show you guys once again how we go about doing it, right? So we click on continue, and then remember, one contract equals 100 shares, right? So if you put in one contract, it's going to be 100 shares. You put in two, it's going to be 200 shares, so on and so forth, right? So you see, it says limit price anywhere from 65 cents to 75 cents. The in between is 70 cents, right? And then you have expire, so it's going to expire today if it's not filled. And you actually can click on that, and it says good to cancel, right? So if you click on good to cancel, it'll stay in place until it hits that 70 cent mark. And then we have minimum credit of $70, right? So they're willing to give you $70 upfront, which is this one right here, for saying you want to sell at $18.50 by August 6th. So if one person went in today, or a person decided to go in today and buy those shares, they can actually put those shares up for $18.50, pick up $70. Now, do you have to pick $18.50? The answer to that question is no. As you can see, they have other strike prices up here, $19.50, and they are offering different amount of premium for doing so. For $19, they're offering 48 cents or $48. $19.50, they're offering 30 cents. So with them offering these different strike prices and the different premiums, you're just going to make more money in between the purchase price of $18.36 and $19, $18.36 and $19.50. So when you start doing the math on that, you're going to make a little bit more money from the sale of those 100 shares versus the premium that you're receiving. Most people would want to go with a higher premium so that they can go ahead and get their original investment back, and then they can kind of start the process over again with the same stock or a different stock. But anyway, hopefully I showed you guys how to do the covered call option trade with Hanesbrands Inc. And once again, if you guys have any questions, concerns, comments, hey, please drop me a comment in the box. Please like, subscribe, comment on the channel. I really do appreciate all the love and support. Hey, you guys have a great day. Bye.